Hey everyone, in the last video we discussed what are hedge funds and we briefly touched upon hedge fund strategies. In this video we're going to delve a little bit more detail into how those strategies work, right? So just a quick recap on what we discussed last time. There are different types of hedge fund strategies or umbrellas, you can say. We have relative value, we have event driven, we have macro, and then we have equity hedge funds. Today, primarily we're going to delve into the equity hedge fund strategies. And inside equity hedge funds as well, we have different sub strategies, right? So for example, we have market neutral, we have fundamental long short, we have fundamental value, then we have short bias, and we have sector specific. And we're going to go in detail for each one of the strategies. But before delving into the details of the strategies, let me first clear out a few concepts which you might hear now and then, right? Firstly, long and short. What do you mean by exactly long and short? So imagine today you feel that, hey, I think tomorrow a stock is going to increase. If you think tomorrow's stock is going to increase, what will you do? You'll go back to the stock market, you'll buy the stock today, and tomorrow once it's increased, you sell the stock and get profit. That's called longing the stock, basically buying a stock. What do you mean by shorting a stock? I can create a different video altogether to make you understand how the mechanics of shorting a stock works. But for now, for this video, you think tomorrow a stock is going to go down. Now, if a stock is going to go down, how do you generate profit from that? You can't just buy the stock because it's going to go down tomorrow, right? So if you want to generate profits where the stock is going down tomorrow, you short a stock. So instead of buying a stock or instead of longing a stock, you short a stock. So for now, just think that if you're bullish towards the stock, you long it. If you're bearish towards the stock, you short it. Simple enough. Market neutral strategy is where you invest in multiple stocks inside the same market. And when I say market, it can mean, let's say, technology, healthcare, banking, and all other markets, right? So here, for example, you're trying to invest in multiple stocks inside the same market and still generate profit irrespective of how the market performs. Meaning, you don't really care if the market is going up or down, you will still profit from your strategy.
My God! Wow!
Sounds confusing, right? Let's delve into an example and I'll make it clear for you. Let's take an example of a banking industry. Right? So if we just consider banking market, imagine I'm investing in two stocks. I'm investing in JP Morgan and I'm investing in Bank of America. I feel JP Morgan is going to go up tomorrow, so I'm going to long it. I don't have such a strong hunch in Bank of America, so let me short it, right? Now there are two scenarios what can happen tomorrow. The banking industry or the banking market as whole can go up, or the banking can go down. Let's take scenario one. In scenario one, when the banking is going up, what would happen? JP Morgan would rise, so will Bank of America. But the intensity at which JP Morgan rises is more than the intensity at which Bank of America rises, right? Now, what were your positions? In JP Morgan, you were long, meaning you would profit only when the stock goes up. In this case, the stock is going up, so you will profit. What was the position in Bank of America? You were shorting it, meaning you were expecting it to go down, but it actually went up. So it's a loss for you. But on a net scale, you see the magnitude of profit is more than the magnitude of loss. In this case, you have a net profit. Let's take an example where banking sector is actually going down. What would happen then? JP Morgan would go down, Bank of America would go even more down. Now, what were your positions back then? You were long JP Morgan, meaning you would only profit if it goes up. It's going down, so you will have a loss. Bank of America has actually gone down and you had bet exactly that, right? So in this case, you will profit because you were short Bank of America and it's actually gone down. Again, in this case, the intensity of Bank of America going down is more than the intensity of JP Morgan going down. Hence, you are still at net profit. So here you can see, irrespective of how the banking sector performs, if it goes up or if it goes down, you always have a net profit. That's exactly what a market neutral strategy is. Amazing, right? In this case, the only thing you have to be aware, or you have to make an assumption, is that JP Morgan usually will outperform Bank of America. That's the only assumption that you have to make. And once you make that assumption, you can deploy that strategy. That's about market neutral. Let's talk about fundamental long short. What exactly is fundamental long short? Fundamental long short is where you actually look at the books and statements of the stock. For example, if you're interested in Apple or Microsoft, you go to the balance sheet, income statement, comprehensive income, right? You look at all the statements, and based on that, you decide, should I go long or should I go short, right? Here, you don't necessarily have to go long and short in one market. You can go long in banking and you can go short in technology. It doesn't really matter. What matters is your decision is based on the fundamental analysis of a company. That's fundamental long short strategy. The third strategy is fundamental value. What do you mean by fundamental value? Here, the hedge fund trader is trying to look at all the undervalued stock. And what do you mean by undervalued stock? Apple, let's say for example, is trading at $100 today on stock market. But if you actually go to the books and records, you see that, hey, actually the value of Apple or the book value of Apple is actually more. It's $110. But market is pricing it at $100. Maybe because something recently happened somewhere else and that is impacting the overall market, which is impacting Apple. That's why the stock market is underpricing it. In this case, the market is underpricing stock of Apple. So in this case, you go long Apple. So here, again, it doesn't really matter which market you do this. The decision should be based on the undervalued stocks. Here you buy undervalued stocks. That's fundamental value. Secondly, we have short bias. Short bias is exactly opposite. Instead of finding undervalued stock, you find overvalued stock. So you see, hey, which company is where the book value is actually lower, but the stock market is pricing it at a higher value. In this case, we say that stock is basically, that company is overvalued and you short the stock because you feel that eventually people will realize the real book value of it and the stock price will go down. Hence, you short the stock. That's short bias. The next one is sector specific. Now, what exactly do you mean by sector specific? Here, you have hedge funds who are primarily focused in just one sector, be it banking, be it healthcare, or be it technology. They will not invest anywhere else but in their own sector. So these consist of like sector SMEs or like subject matter expertise, right? People who have worked, let's say for example, in banking for a long time, who they have traded in banking for a long time, and now they are experts in understanding how the banks react to whatever is happening in the market, and they only trade in banks. So you can go long, short in banking to generate alpha, which is profit. So this is what you mean by sector specific strategies. So today we discussed more about the equity hedge funds strategies. In the upcoming videos, we'll go over what do you mean by macro strategies, event driven strategies, and relative value strategies, which is quite interesting actually. So stay tuned. Thank you.